Welcome back to Daily Finance News, your trusted source for the latest updates and insights from the world of finance. I'm your host, and in today's episode, we'll be discussing a critical topic that has been making headlines recently: how Wall Street is preparing for a possible U.S. debt default. As the deadline for raising the debt ceiling approaches, let's dive into the details and explore the potential implications for financial markets. Before we delve into the preparations made by Wall Street, let's first understand the significance of the U.S. debt ceiling. Can you provide us with some context? Absolutely. The U.S. debt ceiling is a statutory limit set by Congress on the amount of money the federal government can borrow to fund its operations and meet its financial obligations. Once the debt ceiling is reached, the Treasury Department has to take measures to ensure that the government can continue to meet its financial commitments. And what are the potential consequences if the U.S. were to default on its debt obligations? A U.S. debt default could have severe implications for the financial markets and the economy. It could lead to a loss of confidence in the U.S. government's ability to manage its finances, resulting in increased borrowing costs, a downgrade in the country's credit rating, and significant market volatility. Moreover, a default could have a ripple effect on global markets and trigger a broader financial crisis. With the possibility of a U.S. debt default looming, how is Wall Street preparing for such a scenario? Wall Street institutions are taking proactive measures to mitigate the potential risks associated with a U.S. debt default. Firstly, financial institutions are conducting stress tests and scenario analyses to assess the potential impact on their portfolios and balance sheets. This allows them to identify areas of vulnerability and take appropriate risk management measures. Are there any specific strategies being employed to navigate a possible default? Yes, Wall Street firms are diversifying their investments and reducing exposure to U.S. government debt. They are reallocating their portfolios by increasing allocations to assets that are considered safer during times of financial stress, such as high-quality corporate bonds and assets denominated in foreign currencies. Additionally, some institutions are actively hedging their positions and using derivative products to protect against potential losses. How is the market and investor sentiment being affected by the looming debt ceiling deadline? The uncertainty surrounding the debt ceiling negotiations is creating market volatility and increasing investor caution. Investors are closely monitoring the developments and assessing the potential implications of a U.S. debt default. As a result, we are witnessing increased demand for safe haven assets, such as U.S. Treasury bonds and gold, as investors seek to protect their portfolios against potential market turbulence. As we conclude today's episode, it's evident that Wall Street is not taking the possibility of a U.S. debt default lightly. Financial institutions are actively preparing for this scenario by diversifying their portfolios and implementing risk management strategies. The market and investors, on the other hand, are adopting a cautious stance as the debt ceiling deadline approaches. We'll continue to closely monitor the developments surrounding the U.S. debt ceiling and keep you updated on any significant changes. Thank you for sharing your valuable insights on this topic. That wraps up today's edition of Daily Finance News. We hope you found our analysis of how Wall Street is preparing for a possible U.S. debt default informative. Stay tuned for our next episode, where we'll bring you more captivating stories and market updates from the world of finance. Until then, take care and stay informed.